Scott, in terms of the market here, we're, losing a little bit of altitude, although still hanging in there okay. The S&P is up almost 5% year to date. Probably not many thought we'd be there 6 weeks into the year, even as we've reduced the amount of Fed easing that the markets is positioned for right now. What does it tell you, and what's the risk reward look like to you?
Well, Mike, I tell you, I think the risk reward is not good right here, and we certainly wouldn't just go out and buy the S&P 500. But like you said, when you look at CPI, PPI, I mean, those were some nasty numbers if you're worried about inflation or if you're, the Federal Reserve. And the market's done really nothing but keep grinding higher for the most part. So for us, we don't want to go out there and buy the S&P 500. We don't want to go out there and buy the Russell 2000, that's for sure. But I think there's a few things under the hood that you can do.
Was it really nasty numbers, though, coming out of the PPI and the CPI? I mean, obviously more than you wanted to see, and it seems like there's at least a hesitation in this whole disinflation trend. But I don't know, what was it, 2% year-over-year core in the PPI?
Yeah, you can't complain a lot about that, and you're right. The trend in inflation is down. It's not going to move down in a linear fashion. There's going to be a few stumbles along the way. This is kind of a stall here, but certainly we have some confidence, and I think the market has a lot of confidence that inflation is going to keep crawling lower. So, that's why, after a week like we've had, really, the S&P 500 is going to close pretty close to the all-time record high. I think the market's pretty comfortable with that. A lot of people would have said the market's very married to 6, 7 interest rate cuts out of the Fed. We're in the camp that we're going to see 3. And I think really, when the market digests that, it might digest it a little bit better than we would have anticipated because, I think the market's going to be pretty comfortable with 3 cuts this year.
Yeah, market was just flirting with 6 or 7 rate cuts, not married to it. At least it looks like that at this point. So if the S&P 500 doesn't look like it's at a great entry point right here for you, and the Russell 2000, which has started to come around, is also not, where would be?
Well, I tell you, here's what we're doing, Mike. We're taking the sectors that have really outperformed. And if you look at calendar year 23, it was tech, communication services, consumer discretionary that just dramatically outperformed the other 8 sectors. And, of course, consumer discretionary's coughed up some ground here this year. But what we're doing is trimming from there. So we're taking, if our clients have been following our advice, they're overweight all 3 of those sectors. We're recommending that they trim back tech to a neutral, communication services to a neutral. We want them to take consumer discretionary to an underweight. And then we're taking those funds and we're looking at some sectors that haven't outperformed that we think will do well over the coming year or so. Industrials, healthcare, materials, energy. We made a swap with energy and financials. Financials ran a little too far, too fast. We backed off of that and ended up buying energy. We just don't think oil prices are going to go much below $70. So those are the things that we've been doing. But as I said, we've been avoiding just going out there and buying the S&P 500.
Sure, and I should mention we backed off a little bit further here. The S&P is down about 0.5%, and it's an monthly expiration Friday, and here we are right at that round number 5,000 number. So, Scott, just real quick, it seems as if you're not necessarily saying the economy is really going to struggle here, or are you?
Well, Mike, I think probably we're going to see a couple of quarters, maybe the second, third quarter, where, you've got a 1 handle or right around 1 in terms of GDP. It looks like so far anyway, the first quarter's coming in okay. So we're definitely expecting a slowdown. When you and I talked, this time last year, we thought there was a pretty high probability of a recession. That probability certainly isn't 0, but it's a heck of a lot lower than it was, 6 or 9 months ago. So we expect a slowdown. We expect the consumer to pull back here. We think the Fed, as I said, we're only going to get 3 cuts out of them this year. And so I think that consumer spending, higher unemployment, that's going to take a little wind out of the economy. And it's not going to be a disaster, but it's going to be a slowdown that's noticeable.
Yep. All right. We'll be on the lookout for it. Scott, thanks very much. Appreciate it.
Thanks, Mike.